Welcome to Age, Pension, Super and Retirement. I am your host Yvonne, and as always, this is information only and not personal advice. Today, we will be looking at some more Facebook group questions and the invalid and invalid carer offset. To do so, I would like to welcome back Rebecca.
Hi, Yvonne.
Starting off, Julie asks, after some advice for my mum, 79, widowed, she has sold her home and is building a granny flat at my place. She will have a substantial amount of cash remaining from the sale. What would she be eligible for from Centrelink after the sale? And there's also a note, she will put the leftover money in the bank. She doesn't want to do super. If she's living off the interest from her savings invested in a bank, how does this affect assessments?
Okay, so there's a big change of circumstances happening here for Julie's mum. Now, Julie doesn't actually say whether her mum is currently on age pension, but let's assume that she's on age pension, on the single rate of age pension since her husband died, and she's decided to sell her home. So that in itself is a big change of circumstances. When you sell your home, you can use a up to 2 years grace period, if you like, to buy or build your next home. And during that window, the proceeds that you've got from your home that you're not going to be using to buy your next home are exempt from the asset test. So that does help people to stay on age pension for that transition period. So that's one thing that the mum can do. So let's say she sells her home and moves into, like, the granny flat hasn't been constructed yet, so she might be living in Julie's home with her. And so for that period, she's kind of in limbo and hasn't really got a new home yet. So for that period, she can probably still stay on age pension while the granny flat is being constructed. Now, the granny flat thing itself also raises some more issues. So with Centrelink, there's something called a granny flat interest that can be used in this kind of situation where the mum is going to be living in a granny flat on her daughter's property. And depending on how that's set up legally, it can be considered a granny flat interest or a granny flat agreement, which gives an opportunity for some assets to be excluded from the asset test for Centrelink. So she's going to pay to construct a granny flat, but the property is not going to be hers. The property is going to be her daughter's. So the amount she pays to construct the granny flat is not considered a gift to her daughter. It's considered her home. And usually there is an arrangement, an agreement that mum's going to live here for the rest of her life, as long as she's able to. And the payment for that agreement or that right is the construction of the granny flat, which does probably improve the value of Julie's property. Now, when you're making a granny flat agreement, there's also the opportunity to pass on additional assets over and above the amount that you can use to construct the granny flat. So if the mum wanted to, she could give Julie additional money as a cash transfer. And depending on the mum's age, some of that money can be excluded from the gifting rules. So there's an opportunity here, if the mum wants to, give Julie more money and therefore reduce her own assets without it being captured as a gift and therefore counted as part of her assets for 5 years. So Julie's mum should get financial advice, but there are some ways to give more money to Julie without adversely impacting on the mum's pension. But maybe the mum doesn't want to do that. Maybe she wants to keep the money for herself and her own needs, and that's fine too. Depending on the amount left over after constructing the granny flat, if it's a huge amount, then Julie's mum's not going to be eligible for age pension anymore. But maybe she's still eligible for a low income card. Maybe she's eligible for the Commonwealth Seniors Health Card. So there's still an opportunity for some support from Centrelink in the way of a concession card, even if your assets are very high. So the numbers for, what amount left over is going to cancel age pension, those numbers change 3 times a year. So you can, look that up on the Centrelink website. But you're allowed to have a substantial amount of money in assets and still get a part age pension. The other question was about where she puts the money. If she puts it in the bank and earns interest, does that impact on her age pension? When Centrelink's assessing your interest, your income, they don't look at what amount you actually get paid each month by the bank. They use an assumed rate of interest, which is called deeming. They assume a certain rate of interest on all your financial assets. So whatever amount Julie's mum is actually earning in the bank, that amount does not matter for Centrelink purposes. Centrelink's going to assume the income and the deeming rates, so the percentage that Centrelink assumes, those rates change twice a year. They changed in September 2025 and the rates are going up this March. Yeah, those rates are on the website. So the income that Julie's mum is assumed to earn is going to go up and therefore may impact on her age pension amount. Yeah, but the actual interest that she gets each month is not counted. But she does need to think about tax. So the ATO is interested in what interest you're actually making on your money. So when the money is in a bank account, it is subject to normal income tax rules. So if Julie's mum is earning more than $18,000 per year in interest or interest plus age pension, she may need to pay some tax. There's some tax offsets available. So tax-free threshold that everyone knows about is $18,200, but effectively you can earn more than that without paying tax because of the tax offsets available, the low income tax offset and the seniors and pensioners tax offset. She can earn like a fair amount of income before paying tax, but if she's now got a huge amount of money in the bank, she may need to pay some tax on that income. If she puts some of the money into super, whatever's in super doesn't have any income tax implications, but she's decided she doesn't want to use super. She's just going to use the bank, which does keep it simple, but she may need to pay some tax. So that's something to think about. And look, this is definitely a situation where she should absolutely get financial advice to sort this out, to think about whether there is a formal granny flat arrangement happening, whether she should give Julie additional money over and above the construction of the granny flat, what to do with the remaining money, whether she's going to get a pension or not, whether she needs to pay tax or not. All these things would be really good to talk to a professional about.
Such a helpful answer. So many layers and definitely a good candidate for professional financial advice there.
Absolutely.
Now, Sandy asks, I am working part-time and currently receiving $470 a fortnight age pension. Should I be paying tax on this amount? I'm assuming this would be classed as income for tax purposes.
Yes, age pension is income for tax purposes. When you get age pension, if you look on your Centrelink account, it's actually broken down into 3 categories, or at least 3 categories. So part of it is actually called age pension, and that's the bulk of the amount. Then there's an amount called pension supplement and an amount called energy supplement, and those are smaller amounts. And some people are eligible for rent assistance, so that is, again, listed separately, rent assistance. Now, the age pension amount is all taxable income. The pension supplement, this one's tricky because part of the pension supplement is taxable and part of it is not, but you can't actually see that on the payment history that you can look at on your account. You don't actually see the breakdown there of what's taxable and what's not. But at the end of the year, you get a income statement from Centrelink, which does show you exactly how much taxable income you've received, and everything else above that, it does not appear on the income statement because it's not taxable. Yeah, so the age pension is taxable. The pension supplement is part taxable and part tax-free. The energy supplement is tax-free. And then, rent assistance is tax-free. If you're getting an amount of age pension, then yes, you're going to be it's going to be taxable income, which needs to go on your tax return at the end of the year. Now, should she be paying tax on this? Now, the implications, if she doesn't have any tax withheld from that or doesn't pay tax on it, the only bad thing that's going to happen is that she's going to get a tax bill when she lodges her tax return. And a tax bill, it's just a bill. It's just money that you have to pay. And I think people kind of get really worked up about it, like, oh no, I had a tax bill, I've got a debt now with the ATO. Sometimes people can make it out to be a much bigger thing than it is. It's just a bill. It's just like getting an electricity bill in the mail. It's not punishment. It's not a penalty. It's just an amount of money that you need to pay. Now, if you're not expecting to get a bill, I guess it can come as a shock and, can throw you out a bit. It's just a bill that you need to pay. There's different ways to tackle it. You could just, when the bill comes, you just pay it from your savings and it's done. Or you can try and prepare for it you can have extra tax withheld somewhere. So you can ask your workplace, you can say, hey, I just want to have some extra tax withheld every pay cycle. Can you withhold an extra $50, $100, whatever? And that is withheld as tax along with the normal tax that's withheld from your pay. That goes over to the tax office. And then when you lodge your tax return, there's more tax has been withheld. So you're much less likely to get a debt, more likely to get a refund. So that's one way you can do it. Another way is to not claim the tax-free threshold at work. So when you start a job, you are asked to fill in a tax file declaration form and to say whether you want to claim the tax-free threshold or not. So if you wanted to, you could say, well, I'm sort of technically claiming the tax-free threshold at Centrelink because they're not withholding tax. So I will not claim the tax-free threshold at work, which forces your employer to withhold more tax. There's a different tax rate that they withhold when you are not claiming the tax-free threshold, which means, more tax will be withheld. You're less likely to get a tax bill, more likely to get a refund. Another way you can do it is ask Centrelink to withhold tax from your age pension. And they offer you two options. You can withhold a percentage of your age pension or a fixed dollar amount. So you could say, I think my tax is going to be in the 16% bracket, my income. So you could say, please withhold 16% of my age pension. Or you may be in the higher tax bracket and say, please withhold 30% of my age pension. And that will be automatically deducted by Centrelink, 30% of the age pension portion. They're not going to take 30% of the rent assistance or the energy supplement because those parts are tax-free. You can just do that in your Centrelink account, go into deductions, manage deductions, and add a tax deduction in there. So you can say, 16% or 30% or whatever percent you want, or you can ask for a fixed dollar amount. So you might say $50 a fortnight or $100 a fortnight or whatever. And then that just goes to the tax office, and at the end of the year, it's sitting there ready to pay whatever tax you need to. So there's a few different ways to do it. You could also save up some money into a separate bank account, ready to pay the tax bill when it comes. But it's not a big deal. It's not a big penalty or punishment. It's just a bill that you need to pay at the end of the year.
That's fantastic, Rebecca, and I love that perspective of it's just another bill. That's really helpful. Now, Anonymous asks, I want to give some money to my child. I know about the $10,000 per year and the $30,000 in 5 years rule. Is there a way to do the $30,000 gift allowance all in 1 year?
Yes, there is a workaround to do this. So if you give $30,000 in one go, what happens is it's recorded as a $30,000 gift. The first $10,000 is removed from your assets, and then there's $20,000 listed as a deprived asset, a gift, and that stays on your record for 5 years. So that's not the way to do it if you want to sort of get it off your record as quickly as possible. The workaround is this. You give $30,000 to your child, and when you go to Centrelink, you tell them, I've given $30,000, $10,000 is a gift, and $20,000 is a loan. So Centrelink will record that as $10,000 gift that's gone from your assets, and $20,000, instead of being listed as a gift, as a deprived asset, it's going to be listed as a loan, which is still considered your asset. So $20,000 loan. And then in July of the following financial year, you go to Centrelink and you say, oh, that $20,000 loan that I've got with my child, today I forgive $10,000 of that loan. So Centrelink will go, okay, you've forgiven $10,000. We will count that $10,000 as a gift, and that gets removed from your record. And so now there's the remaining loan balance is $10,000. And then the following financial year, in July, you go to Centrelink again and say, so I've got that $10,000 loan still to my son. I'm going to forgive that remaining $10,000 today. And Centrelink goes, okay, no worries. We will treat that $10,000 loan now as forgiven, and so therefore it's a $10,000 gift, and that gets removed from your assets. So that is the quickest way to make $30,000 of gifting go away from your assets. Yeah, that's the workaround. It's completely legal. It's using the $10,000 gifting allowance each year, and your child gets the $30,000, the full $30,000 up front, and you get it off your record as quickly as possible over 3 financial years. So yeah, that's the way to do it. That's the workaround.
What a great answer. I'm sure a lot of our listeners will be very keen to hear about this strategy. Now, Rebecca, there was an interesting post that you put on our Facebook group, and it was about an invalid or invalid carer tax offset. Could you please explain exactly who qualifies for this offset?
Yeah, so this is quite an obscure tax offset. In terms of the whole population, only a very small number of people are going to be eligible for that. Basically, it's if you look after, provide financially for somebody who is an invalid, so they are disabled and not able to earn their own money, if you provide for that person, or somebody who is an invalid carer, so you are providing for somebody who doesn't work because they are caring for someone else with a disability, you may be eligible for this tax offset. Now, there's lots of little sort of nitty-gritty rules with it. So basically they're looking at, imagine a couple where one of them is working, say working full time, and the other one is not working because they are caring for their disabled adult son. And the person working, maybe they're on, say, $80,000, $90,000 a year, they're paying tax on that as an individual, which is how tax is done in Australia. And the partner might be on carer payment and carer allowance from Centrelink, but because the working partner has a reasonable income of $80,000 or $90,000, the amount of carer payment that the spouse gets is quite low. And this is kind of a way to even out the tax for the couple. So, hypothetically, if they were both working, earning half the income each, they would pay significantly less tax as a couple than their actual situation where one person earns the income and the other person is on a small pension. So the tax offset sort of just goes some way to balancing that out, and kind of as if your income's splitting. So the more income that the lower earner has, the person who is the carer or the person with a disability, the more income they have, the less the tax offset is going to be, because they're sort of already benefiting from income splitting kind of thing. The lower the income of the lower earner, the higher the tax offset is going to be. And there is an income cutoff for the tax offset as well. So, if somebody's on, say, $200,000, they're not going to be eligible for this tax offset. So there's a fairly narrow income range where it's eligible, and the person that you're supporting needs to be on one of the Centrelink payments, so disability pension, carer allowance, or carer payment. Not a lot of people are going to be eligible for it, but it's one of these ones where it's not done automatically on your tax return. You have to know about it, or your tax agent has to, and they have to calculate the amount you're eligible for and put it on the tax return so that the ATO will give you the tax offset. So if you do have someone in your life, particularly in your household, who's on one of those payments, talk to your tax agent about, hey, I heard about this tax offset. Am I eligible for this? And can you, help me get it?
That's super interesting, Rebecca. Would you know what the income limit is for someone claiming this offset?
So it's for this year, it's about 120,000. So it's the income limit is the same as the income limit for Family Tax Benefit Part B. So yeah, this year around 120,000, but it does change each year. So yeah, ask your tax agent basically.
And one other question on this, without notice, Rebecca, would you know if someone just hears about this for the first time, how far back could they claim this offset?
Good question. Look, I don't know. That would be one to ask your accountant about, whether you can go back and do previous years and, amend your tax return for that to get that offset. Yeah, I don't know. Ask your accountant.
This is such an interesting and helpful piece of information, because I certainly had not heard of it, and I'm sure that there are many people listening to this who have got something that they could perhaps claim for that they didn't know about. So thank you again, Rebecca.
That's all right. Now, so the tax offset, the maximum amount is about 3,300. Like that's a decent amount. Certainly helps when, if you're paying $12,000, $15,000 of tax. It's nice to get something like that offsetting that amount.
It certainly is, Rebecca. Thank you so much. As always, this has been information only and not personal advice. For our international listeners wishing to join our Facebook group, the code word is yellow. Thank you so much, Rebecca.
You're welcome, Yvonne.